The Bank of Canada cut its key interest rate again today, and the governor of the central bank hinted at more cuts to come.
We are increasingly confident that the ingredients to bring inflation back to target are in place. If inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate.
This is the Bank of Canada's second straight rate cut. The first was in June after a long cycle of rate hikes that began in the spring of 2022 due to soaring prices. With inflation now within that target zone, interest rates can begin to come down. Currently, the benchmark is at 4.5%. To break down what this most recent cut means for Canadians, Armine Yalnizyan is the Atkinson Foundation Fellow on the Future of Workers, and she joins me now. Armine, it's always good to talk to you. Thanks for taking the time.
Thanks for inviting me.
What do you make of Tiff Macklem, the Bank of Canada governor's reasonings behind this rate cut?
Oh, I think it was absolutely correct. And I think he actually said, Carolyn Rogers, the senior deputy governor, they both said that we are in too much restraint right now. Oh, it was overdone maybe, and it's time to start cutting, but they're going to be very ginger about it. It's their job. Their job is to bring inflation down and bring our expectations about inflation down. And that's what they're doing. But you can't starve the beast by having unemployment grow too much and actually putting a kibosh on the thing that is driving most of the costs, which is housing. And there's so much reduction in builds right now, and in people being able to buy half the number of houses sold in Toronto in the first half of this year as last year. That's their rates.
Okay, so this is a quarter of a point, right? So down a half point total over the last two rate decisions. That's not going to make a huge difference for most Canadians. I mean, how do you anticipate this cut being felt by people in their everyday expenses?
Well, you're hearing the sigh of relief across the country because they are anticipating this is the first of a series of cuts. Right. But to your point, if you have a $100,000 mortgage, you're probably going to be saving $50, $60 a month. If you've got a $400,000 mortgage, maybe $1,000 a month. Like, it depends on your amortization rate and how much you've borrowed, but it's really not going to make a big difference for small borrowers. But the fact is, David, that a lot of the new buyers who are both investors and first-time buyers that came into the market during the pandemic when rates were rock bottom low are deeply over-leveraged. So these mortgages that are going to get renewed are really large amounts. So it may make a huge difference for some people as these rates start coming down significantly. But we know half the mortgages that are out there on the market need to be refinanced in the next year and a half.
Right. So this is one of the things that the bank points to, that while they are seeing price stability and decline in inflation across a lot of factors, housing and shelter are still way up, and they're still a key component to what's baked in at an inflation rate of about 2.7%, if I remember what the most recent CPI report was. What are your thoughts on that this is the thing that is now hurting people, and that is the thing that is most directly affected by the monetary policy of the governor of the Bank of Canada?
Indeed it is. And yet, if they drop rates too fast, then we get another surge in pricing as people rush into the market. So they're walking a tightrope on how they deal with the fact that their rates affect demand for housing and also affect, on the other side of the equation, how many new houses get built. So we are in a chronic position of undersupply for the number of people that need, especially rental housing right now. And that's not going to get fixed until rates go down, but rates go down too fast, and you're going to get a big bump up in ownership and mortgage costs. So, we're between a rock and a hard place on the housing story. And don't forget, housing is the biggest bite out of everybody's budget, whether you're rich or poor. So it's not just the pace of growth in mortgage costs and rents and insurance, but it is the amount of your budget that is taken up by these huge hikes. So we've been rightly focused on food inflation for a while now because that beat the band for the longest time. But now the chickens are coming home to roost on what these rate hikes have meant to the cost of our most essential human need, which is shelter.
Right. There's cost. There's also supply, as you point out. But a lot of developers will tell you they can't start building until the borrowing costs come down. So there's a chicken and egg factor here. So Tiff Macklem is suggesting that, look, inflation's going in the right direction. They're going to be cautious and very data-driven. but there's no forward guidance like we've seen before, but there's certainly the insinuation there pretty bluntly that, yeah, if things keep going the way they're going, we're going to see more rate cuts. So where do you see this going for the rest of the year?
Oh, I will absolutely not crystal ball it with you, because this has got to be the goofiest year politically that I have ever seen in my life. Given everything that is happening in Europe, in the United States, in China, in Russia, in the Middle East, I am not going to predict where things are going. Any one of those things could actually trigger another round of inflation. And that's why they are saying they're data dependent. That's why they are not providing forward guidance, because there's so many wild cards in the mix now.
Okay, let's just talk about the United States, because normally, not always, but there's often an alignment, at least directionally, between the Federal Reserve in the United States and the Bank of Canada in terms of interest rate cuts. And there's a divergence happening now that we have made 2 cuts here in Canada, the first G7 country to make cuts, and while the U.S. is holding because they're still seeing some overheating in their economy. What are the implications of that? Do you have any concerns on a divergence in monetary policy between the 2 countries?
Oh, that's always something that everybody looks to. And as an economist, you know that over the last quarter century, we have seen these divergences since the year 2000 at least 4 times, where the United States has had a higher policy rate than we have, and for a protracted period of time. But if you look at these 2 curves, you see that the United States is way more variable in how far deep they will cut, how high up they will, like, we're actually more stable. It's hard to believe it, and we do move directionally the same, but we don't, nobody does extreme the way the United States does. And that's true of the Fed as well. But to your earlier point, they're still stimulative because they're still trying to cool a very stimulated economy, which is running very hot. It rebounded after we did in Canada. So it is still coming off the sugar high, which is the post-pandemic opening. And we'll see what it takes to slow down. But everybody's expecting economies to slow down. There's lots more bank economists now saying that we may be looking, in fact, at some kind of a modest recession at the end of 2024. That's what it looks like in Canada, even though the Bank of Canada's forecast today said, now we're going to be growing. We're going to actually be growing okay in the second half. But there are enough signals that really we're walking a tightrope on whether it is a small contraction or a small growth. And that's a really tough line for any central bank to walk.
Yeah, and the U.S., it should be pointed out, Armine, it is an outlier even amongst the G7. Its growth rates are just so much higher than everybody else's, right? It is because of the Inflation Reduction Act and their giant trillion-dollar deficits that are pumping up the economy.
That's correct.
Right.
Yeah, that'll come back to bite them because of those incredibly high rates, right? Their debt servicing charges are going to be really difficult to handle.
Yeah, lots of things to watch for south of the border. Armine, thank you so much. That's Armine Yalnizyan, Atkinson Foundation Fellow on the Future of Workers. Thank you so much. Always good to talk to you.
Thank you.